Hello and welcome to Bloomberg Quint, the top headlines at this hour. Some respite for markets after 3 days of losses. The Sensex and the Nifty extend morning gains to rise over 0.5% higher. In Reliance, Anil Ambani Group company stocks head lower after Arcom defaults on a bond payment. Suzlon Energy falls as much as 7% to its lowest levels in a year after suspending operations at the blade-making unit. And Firepesa Capital settles at 350 rupees per share on the NSE post its demerger from the IIFL Group. Those are the headlines. I'm Agam Vakil. Up next is Hot Money with Darshan Mehta.
Hey, thank you, Agam. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show, Sangeet Lakkar of Newberry Capital, Avinash Gorakshakar of Joindre Capital, and Yogesh Mehta of Motilal Oswal Securities. They all join us on the show. Thank you everyone for joining us on the show. The stocks that we'll discuss today on Hot Money include CEAT, JK Cement, Nestle, L&T, and M&M. So these are the stocks that we'll be discussing in detail. Okay, the first stock that we'll talk about is CEAT. The numbers came out pretty strong set of performance. If you look on a year-on-year basis, yes, it looks weak, but much ahead what the street was anticipating. Yesterday was up, today also is trading up. All the tire stocks did manage to show a sizable volume growth this time around. The numbers were good. Let's ask our guest what they feel of CEAT. Yogesh, I'll start with you. Any view on CEAT? Do you think that tires as a space is doing well, and is CEAT the best play in the tire space currently?
Yeah, Darshan, see, tire companies have good advantage right now post GST as well. Now we are seeing restocking. The numbers for CEAT particularly were not so encouraging, but when we listen to the call, it seems that, post GST, if you don't factor in, then also the sales was almost flat. But they are doing, and also they are doing, looking at second half as a better benchmark there because of the raw material price which was increased in first quarter. Now it has gone down by almost 6 percentage point. And still there seems that the advantage would be there ongoing on various cost-cutting measures. Plus, the quarter was not so good because of the currency appreciation. Then Egypt has a problem. Then Kenya and Indonesia has unrest, political unrest. So all those were very much a negative advantage for them. But now all being settled now, and the increasing tonnage capacity from Ambanath plant, the Nagpur plant, and the Halol plant. So that will boost some more profitability for them. And market share is of course 10% in passenger vehicle, 30% in the two-wheelers. So that will give more advantage to them to grow more from here on.
But is CEAT the best play, or would you? Because CEAT is no doubt cheap. If you look at the valuations, comparing it to the other players, it's one of the most expensive stocks, and margin-wise, it is pretty much not the best performer. So, would you recommend sticking with CEAT because you believe that the outlook that they've given is positive, or would another tire stock be better?
No, even we believe that on an analysis basis, we have not compared this MRF, which has entered into two-wheelers and four-wheelers and three-wheelers now. But looking at CEAT on those parameters, we believe that 6 to 12% PET CAGR and EBITDA growth CAGR is visible for FY 17 to 19, and we will stick to that. There is the best play to for the tire industry to play.
Okay, Avinash, do you agree with Yogesh? Is CEAT a good play to start accumulating? What's your view?
I think if you look at the numbers, I think top line growth came in at around 7%, and I think EBITDA margins definitely were under pressure. But if you compare it to the other players like, let's say, an Apollo Tyres, I think numbers are definitely better. Our sense is that most of the growth for CEAT would come in from the passenger car segment, where they have a decent market share, and with many product rollouts expected in the next couple of quarters, I think margins definitely, even if they stay stable, hopefully rubber prices have started softening, and if the crude price also settles down, then I think you could see margins getting protected and volume growth kicking in. So I would believe that yes, in terms of valuations, it may a tad little expensive, but in terms of the revenue visibility, CEAT definitely looks better in considering that it's a frontline tire company. So I think I would not immediately buy it. Look out for a correction. But yes, within my portfolio, I mean tire stocks, if I were to keep, I think CEAT would definitely be there.
That would be your top pick, or would you choose an Apollo or an MRF or some other tire company over CEAT?
I think if you compare Apollo and CEAT, my bias would be on CEAT, and MRF Darshan is in terms of price, you can't compare it to CEAT. I would believe that I think both these companies definitely have a wide kind of price differential. So, CEAT definitely could give in a kind of a 14-15% upside, hopefully over the next, say, 12
Price is
months.
fine, but valuation, MRF is trading at 23 times, CEAT is trading at 22 times. MRF on a next year is trading at 17 times, 14. It's just that, MRF has not given any bonus. Or stock split. That is why the price looks so this thing. But in terms of that, that's why it's absolutely comparable to compare an MRF and CEAT.
No, comparably, in terms of valuations, your point is right. But in terms of the kind of incremental kind of upside and the fact that CEAT has been putting up incremental capacities, and hopefully, with the rubber price reduction, I think CEAT is one of those companies which I think possibly could do much better than the other players. So CEAT would definitely, be in my pool.
Okay, it's a 2 thumbs up for CEAT. Sangeet, what's your view? Do you agree with them or you have a different view?
I have a different view. I am not very optimist on the sector. I feel it's a very commoditized play. So if you see the numbers, the 50% of the sales is your raw material cost, which essentially is rubber prices. Unfortunately, all these tire companies do not command any pricing power. So just to elaborate on Yogesh's point, so even if you see for CEAT, the Q1 and Q2 numbers, the EBITDA margin were marked difference because of the rubber price differences. So that itself implies that you are not able to pass on your costs to your customers. And even on a longer period of time, so when 2010, when the rubber prices were at peak, these companies used to report losses. So I'm not very and it is expensive. Even last couple of years, the rubber prices have been little soft overall. And having said that, still they are reporting about, so CEAT is making about 300-400 crores of profit. That's the best case scenario, and it's trading at 20-25 times, which is not cheap by any standards.
Yogesh, you want to respond? Because I think his concerns are valid, because valuation a few years ago, all these companies were single digit valuation. Now they've come up and it's a commodity business.
See, every company has some advantages, some disadvantages. If you compare crude prices, which were at $140, $120 a few years back, and now it is often to $28, it went down to in some point in the last 2 years back. So that correction we have seen. So similarly, when you want to play, we are not looking at the investment play over 5 years, 10 years. We are looking at 1 year projection down the line, FY19, FY20 at the best. So that vicinity, we are seeing that rubber price will remain softened there, unless and until you see any uptick in rubber prices. That is a valid point. Yes, I take it. So that point in time, you can review your things, but still then you cannot say that I will not touch this sector.
So it's like this. I don't have a view how the rubber prices will be there 1 year from now. So I might as well look out for a business who commands some kind of pricing power. So for example, a Balkrishna Tires, which is again into tire space, but a very, very niche business, very separate from the commercial or a passenger vehicle tire. They are into off-highway tires. And if you see that margin trend, in spite of the rubber prices going ups and downs, they have maintained their margins.
Their margins are almost double of what the others are doing.
Exactly. And if you compare it again to a 5-year, 10-year earnings chart, the margins have remained stable.
Okay.
So, and trading at similar valuations.
Okay, so that's the view that's coming in on CEAT at this point of time. Yogesh and Avinash are bullish on CEAT at this point of time. Sangeet does not share the same view on CEAT currently. He does not believes that the company does not have pricing power. It's a commodity business. He would rather look at something like a Balkrishna Industries, which has been in a niche play but has been able to maintain its margins. Let's move on to the next stock, and that is JK Cement. The company, as the stock is up almost 50% this year, is there more steam left? If you're looking at the valuation on an EV to EBITDA basis, not the expensive, it's one of the cheaper counters, basically based in North India. So let's find out what our guests have to say. Avinash, I'll start with you. Any view on JK Cement?
No, I think numbers have been extremely strong. In fact, realization growth, volume growth for the quarter 2 was very good. In fact, there are large players in the white cement segment where possibly almost 30-35% of the EBITDA comes in. In terms of valuations, I think as you rightly pointed out, this is definitely relatively cheaper compared to the frontline players. But still, if one were to buy it at the current levels, I would wait for a correction. Yes, I think in terms of the incremental volume growth, the management was pretty confident that they are looking at a 7 to 8% kind of volume growth. So I would believe that a correction should be used to get into the stock. Yes, in terms of the pricing power, in terms of the geographical pockets this company operates, I would give it a EV to EBITDA of roughly about 9 to 10 times based on say FY18 and FY19. And yes, on a decline, definitely this stock can give a decent risk-reward ratio. But even at the current level, I would believe that it could be a moderate market performer, not a very significant outperformer in that sense.
What about you, Sangeet? Any view on JK Cement?
So I'm positive on the cement sector. So if you see the sector as such, it works. So if you see the demand side of it, you are talking about housing for all and infrastructure push and all sort of things, which will push up the demand. And more importantly, on the supply side, you don't have a very significant supply being added by the players. So that gives a lot of comfort on the sector as such. And JK, as Avinash pointed out, is amongst the cheapest on the lot. So I'm neutral to the stock, sort of. Again, valuations, though comparatively would be cheaper, but on an overall basis, the market has a lot of froth, which I believe.
So what's your top pick in the cement? You said that you're bullish on the cement sector.
So I like JK Cement as such, but it's not my screaming buy type of.
So what do you do your screaming buy?
I like
in the
Dalmia Bharat, but no screaming buy in the sector as such.
Okay.
Dalmia Bharat is something which is more east focused, where I feel the incremental demand would come in because of the government push to the eastern side of the geography.
Okay.
So Dalmia Bharat and JK Cement, but as such I'm neutral to the counter.
Okay, so that's the view. Yogesh, do you share a view on JK Cement?
See, we are bullish for almost all the cement companies like JK Cement, if you name it, Birla Copper, Dalmia Bharat within the peer group category. So JK Cement has got 10.5 million ton of a capacity into grey and 0.7 into white cement, and plus they've got putty also. Now North region has commanded very well this time because of Binani has ramped down the capacity. Yes. So that has done well, and clinker export to Nepal, that is also doing very well. So now what we believe is that white cement certainly deserves a premium, and we are valuing at 12x for EBITDA for FY19, and if you compare grey cement also, that will be 8 times. So on that reasonable valuation, we are still bullish on this stock, that it can have a decent return of 20-25% can be achieved from 1.5 years down the line.
Okay, so that's the view that's coming in on JK Cement at this point of time. Avinash and Yogesh both are bullish on JK Cement. They believe that the valuations are reasonable. Sangeet is saying that the cement sector looks good at this point of time. Probably Dalmia Bharat and JK Cement would be his preferred choice at this point of time, but not at this price. He says not a screaming buy at this point of time. Let's move on to the next one, and that is Nestle. The counter is trading at almost near fresh lifetime high. It's trading, if you're looking at the valuation on this year basis, is in excess of 50 times. On next year basis, it's close to almost 44 times. So is there room for the company to grow? Are the valuations decent, or is it expensive? I'll ask you, Sangeet, first. Nestle, what's your view?
So in terms of business, it's an extraordinary business. I mean, it's incredible how dominant position they command in so many SKUs. But again, valuation wise, I don't have any comfort. I don't see any room that the PE can expand from here on. So I remain bearish on the stock purely on account of the valuations.
Okay, but look at the return ratios are strong.
Excellent.
They've been growing, but it becomes sometimes that where sometimes such companies deserve high valuation. And if you're looking at it, it's still cheaper than Britannia, I believe. It's much more expensive than HUL, but it's cheaper than Britannia. Then also you would say that
So I'm not positive on Britannia either. So all these companies, if you see 4 years back, they used to trade at half the valuation what they are trading now in terms of PE multiples. I don't understand what has changed in last 4 years, for them to double the PE valuation. I have not seen that kind of an extraordinary growth coming in for any consumer companies, for me to justify such valuations.
Okay, valid concern, Avinash. Nestle valuation?
I think I second Sangeet's point that valuations definitely are not cheap. But if you see the operational improvement in the third quarter for calendar year 2017, I think a 350 basis point improvement in the EBITDA margin, a very strong growth in the bottom line. I think Maggi, contributing significantly. I would believe that yes, valuations are rich unless the stock actually corrects. This doesn't give you a opportunity to actually multiply your capital significantly. But yes, in terms of the business structure, in terms of the urban consumer story, I think they are are very well positioned. I think their strategy across all the SKUs is working very well. So definitely, if the price corrects, and definitely if there is a kind of correction, then only one could look at acquiring. But yes, those who have it should definitely ride the wave. I don't think you could possibly see a deeper correction, assuming that earnings growth and the volume growth for all their SKUs do come in. So I would definitely be positive in the longer term, but in the short term, this does not give me a screaming kind of buy within the sector where I could possibly say, a 15-20% uptick is possible.
Sangeet, what in the FMCG space would you find attractive at this point of time then?
At this point of time, nothing. To be honest.
You wouldn't like this thing. Yogesh, any view on Nestle or the FMCG space?
Yeah, Darshan, see, I do agree that the valuations are expensive and we have a neutral stance on that. But earning is recovering now again since last 1 year. Gone are the days when Maggi had an issue and it was a doldrum on the company's balance sheet, and they're bleeding with that. So now they're again back to the commanding positions, and Maggi every day, all are doing very well. And we believe that financial ratios are also very high on return on equity, on capital employed and ROCE way. So, but only the concern is only valuations, which is, I think now 43, 46 times for Britannia or the Nestle or any other stock like Hindustan Lever. So it is, peer category is similar to that, but only concern on 63% is with the promoters, and floating stock is very less available in the market because we have large investors who are holding it. So that is the only concern, but otherwise it's a good stock, but neutral rating is there. Rest all, we don't feel that there is any legacy in the company.
Okay, but anything else that looks as a house that looks good in the FMCG space that you all are indicating to your clients?
Yeah, we are bullish and we are recommending Hindustan Unilever at this point in time. Looking at the volume growth they are showing in last 3-4 quarters consistently, and even Britannia, which has come out the result with 5% volume growth on the second quarter, and Central India market has also grown by 1.7% market share almost. So that gives some kind of a reasonable foreseen future that yes, it will be a good growth story ongoing and will remain there.
Okay, Avinash, you think that the GST impact is now over for FMCG companies, not Nestle in particular, but the sector? Do you think that they will be able to bounce back in the next few quarters?
No, I think volume growth definitely should kick in much better because across categories, I think GST has now reduced significantly. So I think this second quarter was supposed to be a bad and a horrible quarter, but despite that, volume numbers have been pretty decent. So hopefully, if everything works out well, I think volume growth push definitely, Darshan, should get a significant boost in the third and the fourth quarter because of this GST tax changes which the government has announced.
Okay, so that's the view that's coming in on Nestle at this point of time. Sangeet is not at all bullish. He says that valuations are extremely expensive for Nestle at this point of time. Avinash is bullish on the counter. Yogesh has a neutral weightage on the counter currently. Before we move on, here's a quick recap of all the guest view that we've covered, guest view on the stocks that we've covered till now. Okay, the next stock that we'll talk about is the big boy of the infrastructure space, and that is L&T. Came out with numbers. If you're looking at the numbers as a financial, yes, the numbers were good. They managed to maintain their revenue guidance, their margin guidance, but the big disappointment that came in was the order inflow guidance, which they said that initially, which was 12%, they said that they will grow the year flat. That means from a 12%, they don't believe that there will be any growth, and they've pretty much blamed it on slow-moving government orders and issues as far as Middle East is concerned. Is L&T out of the woods? Is the construction sector, is there more concern that are there in the construction sector, or is the worst over? Let's ask our guest. Yogesh, I'll start with you. Any view on L&T?
See, L&T, if you consider right now, GST-related transition has given a delay to the orders flow, and they've lost large orders into power and defense. But that is not the end of the story, though it is there. But 2.6 trillion worth of INR worth of order book is there with them, and this year also 1.7 trillion kind of order book will be flowing, even though it is a slow one. And guidance, of course, it has been revised downwards, but still we believe that there is no other choice. If you want to go for E&C play in India, then choice remains only with L&T. And given that hydrocarbon is doing very well for them, which has set off effect of the EBITDA and the margin they have lost into the different segment. But we believe that yes, it is a continuation story, and L&T would be the preferred play if you want to have a make in India theme or the infrastructure play in India.
No, but I don't agree with, I think I've heard this enough that, there's no other alternative, but there are tons of construction companies in India. Take for instance Dilip Buildcon. Most of the projects that they do, they actually get a bonus for completing it much ahead of schedule. There is KNR construction. So how can this argument be justified? There is no other alternative. There are tons of. If you say capital goods, I can pinpoint to a few one. But infrastructure, there are tons of companies. A lot of them are doing well.
See, all those are. I agree with that, Darshan. But if you want to compare a larger pie on the ground, that this can be taken care by this company on the larger play and the large order book, then L&T is the only one which can do that. If you want to travel A320, then it can accommodate 320 passengers, but in a helicopter it can accommodate only 3 passengers.
Okay.
So even if you take 10 helicopters, it will not be equivalent to the one A320 aircraft. Okay. So similarly, Larsen & Toubro is the only is the only company which is capable enough for taking care of execution till the execution. And yes, on the smaller projects you can do a completion on the timely basis or before time, but on the larger it takes time, and mainly those are government orders.
And you think that issues with the Middle East, the hydrocarbons, everything is pretty much done for, or are concerns still there for L&T?
Even Middle East is still a concern there, and hydrocarbon may see some improvement ongoing from next financial year onwards, or maybe 6 months down the line. So we'll see some good improvement there on those fronts.
Okay, Sangeet, any view on L&T?
I'm neutral to the stock. It's a proxy play on Indian infrastructure, which has been the theme since the time I have started learning about markets. But so it's a very crowded trade. I mean, it's an institutional favorite stock. So for a retail investor, I would advise that you can look at a more niche stories within the infrastructure. As you mentioned, KNR, it's a fantastic business. There's another niche company, GPT Infra, which is into making ROBs, and they manufacture railway sleepers. So I mean, you can get market returns, normal market returns. It's a good portfolio stock, but I don't think any alpha is possible in this kind of.
Okay. Avinash, any view on L&T? Are you bullish, bearish, or?
No, I think I would be longer term positive, because in the defense category, I think L&T definitely enjoys very strong capabilities, and I think here the order book surprise on the upside could be significant. Maybe orders are lumpy, so they obviously would take some time to come in. But I would believe that defense is one space which, apart from infra, L&T is very strong, and clearly, this is one sector where possibly some good positive surprises both on the order book inflow as well as on the margins could come in. So clearly, I think in terms of the near-term challenges, I think in terms of the order book inflow, management has sounded very cautious. But if you look at FY19 and FY20, I think definitely as the economy moves, into high growth trajectory, I think L&T is definitely going to benefit. So there's no doubt that this price obviously discounts most of the negatives, and I don't think you're going to see a significant downside. So somebody who's got a 2-year view could definitely chip in and really look at it from a slightly medium term kind of horizon.
But do you agree with Sangeet that a stock like L&T would probably give you market related returns only and could not outperform?
I think clearly in terms of the stock size, I think in these kind of stocks, Sangeet is right. Probably you will not get a 2x or a 3x kind of return. Obviously 15 to 20 or 25% is the max which one could expect. So this is a portfolio stock which can give steady returns, and this is definitely not one of those stocks which can give you a multi-bagger return.
Okay. See, Darshan, I have a point there. Even if you look at KNR construction, the balance sheet, and the Dilip Buildcon DBL is also a very strong point. There are IRB infras also where you can't rely on those numbers. But what if there is any small company and you get a delay in orders or maybe a cancellation of order, then suddenly overnight you will see your balance sheet is bleeding.
No, but L&T also had significant amount of order cancellation. I think, I believe a year ago they also returned so many of their BOT projects also.
They had. So see, compared to large balance sheet, this is my point. This is an investment we are recommending here, not that you jumped into into that. But when you get an order cancel of 25%, 30%, you still have room, and leg room is there, and the headroom is also there to accept more and more. But now smaller company size, if you get decay in your order, cancellation in your order, then they will not be able to stand any more in that pipeline.
Okay.
So that is the only catch. But I don't say that don't buy into small companies of the infrastructure. Yes, they have potential at this point in time. But this is an investment portfolio investment which will give you 15% returns on your portfolio. And yes, KNR construction, we have a coverage and we are recommending to our customers. It's a great story and can be continued on a holding side.
Okay, so that's the view that's coming in on L&T. Avinash and Yogesh are bullish on L&T. Sangeet is saying that, probably will give you market returns, probably a KNR Construction would be a better choice. And moving on to the final stock is M&M. Came out with very strong set of numbers. The entire auto pack came out with very strong set of numbers. What's next for M&M? Trading at much higher valuations than a Tata Motors, but is it fair valuation? What should one do? I'll start with you, Yogesh. M&M, any view?
This is the second consecutive good monsoon, but yet, it's a portfolio stock again in M&M, but we would prefer more like Maruti or in two-wheeler segment Escorts or maybe in two-wheeler segment TVS Motors rather than M&M. But yes, second consecutive monsoon, UVs are good, a good play, tractor is doing well, but yet new launches are still on the delay side. They have done XUV post that we haven't seen anything into that. Still Bolero and Scorpio and XUVs are doing their ramp up into the sales. So we believe that yes, it is a portfolio stock. We are valuing at a high side on the buy side, but neutral to bullish, not the gun go buy.
Okay, what about you, Avinash?
I think clearly from a short-term horizon, there could be some challenges because recently, pollution kind of worries from NCR have stated that possibly high taxes could come on diesel vehicles. But overall, the structure looks very strong. Tractor business grew by almost 31%. The farm equipment business generates EBITDA margins of almost 22%. So I would believe that yes, somebody who's looking at a 2-year exposure, this is a stock trading bonus. Definitely, one should look at it as a portfolio stock where returns could definitely be not very significant. But yes, obviously, 15 to 20% returns on a compounded basis over the next 2 years is definitely possible.
Okay, so it's a 2 thumbs up. Will you have a thumbs up or thumbs down?
It's a thumbs up from me. Again, I think valuations are pretty cheap. If you take into account the subsidiaries, the investments which they have, and at a 30% holding company discount, it's still available at 12 times the core business. And as such, I'm very positive on the agriculture and allied space, with government talking about DBT and farm income double by 2022. So I'm very positive on the space as such. And Mahindra is the largest in the tractors, and it's a rural focused play. So I'm very positive on that.
Do you think that the rural recovery is actually happening? Did the tractor numbers show that? Because
it did.
Because what happened was Escorts gave a very negative outlook for the second half for tractors. That's why I'm asking.
So I think, if I'm not wrong, the numbers were strong. The tractor numbers were strong, and besides, so it also has the investments in the various Mahindra companies. And again, if you talk about valuations, 12 times is cheap.
Okay. So that's the view that's coming in on M&M. It's a consensus thumbs up from all our 3 guests on M&M. Before we wrap up on the show, here's a quick recap of all the guest view on the stocks that we've covered till now. Okay, Yogesh, Avinash, Sangeet, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Thanks for watching Bloomberg Quint.